It's our critical session in taxation. We started on the impacts of taxation, whereby we looked at the direct method and the indirect method. Then we moved to basis of taxation, whereby we looked at the proportional, progressive, regressive, and the regressive. So I want us today, we now proceed to where we left rates of taxation or rate of taxes. After determining the taxable income, also referred to as accessible or chargeable income or loss of a person, the person is taxed. There are two rates of taxes. One is the corporate taxes, which is actually imposed on companies. And then we have two, which is the company, which is the individual rate of taxes, which is imposed on individual earnings or imposed on people. Corporate tax, when you talk about corporate tax, this is actually the tax which is normally imposed on individual, on companies, or corporation. The corporate tax is applied to legal person, such as companies, financial institution, cooperatives, and any other incorporated institution under Companies Act. Corporate rate of tax from year 2000 to date is 30% for residential corporations. From year 2000 to date, a non-resident company with permanent establishment in Kenya is taxed at 7.5%. So these are the rates of tax which is actually imposed on corporates. So we have residential, which is 30%, and non-residential, which is 37.5%. Not to be taken, the corporate tax applied to company may therefore change if percentage of the listed share capital exceeds 20% of the issued share capital. The applicable tax rate will depend on the percentage of the issued share capital listed at the Nairobi Stock Exchange. So the imposition, so the company is only taxed on the basis of how much shares have been listed in the stock exchange market. Listed companies. Companies listed on any security exchange under the capital market will always be charged the following rates. If a company listed at least 20% of its issued share capital listed, the corporate tax rate applicable will be 27% for the period of 3 years, commencing immediately after the year of income, following the date of such listing. So we are saying if a company is not listed, it's supposed to pay a corporate tax of 30%. But if the company is listed in stock exchange, it will only pay 27%. If a company listed at least 30% of its issued share capital listed, then the corporate tax rate applicable will be 25% for the period of 5 years, commencing immediately after the year of income following the date of listing. Again, if the company lists 30% of its issued share in the listed stock exchange, then it means they will only be taxed 25%. If the company listed at least if the company lists at least 40% of its issued share capital listed, the corporate tax rate applicable will be 20% for the period of 5 years, commencing immediately after the year of income following the date of such listing. Again, if it is 40% listed in the share capital listed, then we have 20% being taxed. So the taxation component is on the basis of a company listing its shares in the capital market. If it is 20%, you'll be taxed 27%. If it is 30%, you'll be taxed 25%. If it is 40%, you'll be taxed 20%. So we are saying a company which is not listed in the stock exchange will pay a 30% tax, or corporate tax will be 30%. If a company has 20% shares listed in the company, will pay 27% in corporate tax. If it has 30% listed, it will pay 25%. If it has 40% listed in the share capital, then it will have 20% corporate tax. So there are a lot of advantages of getting listed in the company. If your company is listed, you will get some waivers from the corporate tax component. Individual tax rate. So we have seen the corporate. So we want to see the individual tax rate. The rate of tax applicable to individual, natural person. Remember, the corporate tax is applicable to companies, is applicable to artificial person, is applicable to legal person who has been legalized by company. But now when you come to individual tax rate, these are rates which are applicable to individual, a person earning revenue. An individual is taxed at graduated scale rate such that the higher the income, the higher the tax, as follows. These rates are effective on 1st January 2021. These rates of tax includes wife's employment, self-employment, professional income rates of taxes. So when you talk about tax rate for individual, we have tax band or tax bracket, which actually on the first one, when you are earning between 0 to 24,000, the tax bracket is normally 10%. The tax rate is normally 10%. The next one is actually between 24,000 and 1 shilling and 32,000. You will be taxed 15% as a tax bracket. But anything above 32,333, you will be taxed 25,000, 25%. So the tax bracket is critical for the imposition of tax by the taxing authority. So when you give yourself a tax So we need to have this in mind, that the tax bracket is critical for determining the tax to be paid by individual. Individual income tax is charged for each year of income on all the income of a person, whether resident or non-resident, which accrue in or was derived from Kenya. An individual is taxed at gradual scale such that the higher the income, the higher the tax, as follows. So when your actual income is increasing, your rate of paying tax will increase. So the tax bracket is critical in determining the amount that should be paid by the taxpayer. So individual tax ban and tax rate. Tax ban on the first one is up to 24,000, that's monthly, but yearly it's up to 288,000, which the tax rate is 10%. On the next, 24,001 shilling to 32,333 per month. So the tax per annual is 2,888 and 1 shilling to 388,000, which the tax rate is 25%. On all income in excess of 32,333, or when you talk about per annum, 388,001 shilling and above, then you are supposed to pay a 30% tax. Taxation for the non-resident employment income. So when you talk about taxation of non-employment income, any amount paid to non-resident individual in respect of employment with or service rendered to an employer who is resident in Kenya or to a permanent establishment in Kenya is subject to income tax at the prevailing individual income tax rate. So non-residents are, however, not entitled to any personal relief. So a resident person is entitled to personal relief. Non-resident is not entitled to personal relief. Tax relief. So when you talk about tax relief, what do you mean by tax relief? Tax relief is an incentive that reduces the amount of tax that a person has to pay. Personal relief. Every resident individual is entitled to a personal relief of 28,000 per annum, which is 2,400 per month, with effect from 25th April 2020. Now we have again insurance relief. Every resident individual is entitled to an insurance relief of 15% of the amount of premium paid for self, spouse, or a child. However, it shall not exceed 60,000 per annum. Insurance relief applies to the following policies: life insurance, education policy with maturity period of at least 10 years, health insurance, what if I am exempted from individual income tax. You are still required to fill return and enter a valid exemption certified number. So we are actually looking at the perspective of relief. So there are two relief, personal relief and there are insurance relief. And this all relief will reduce the payment of your taxes.